90% of traders lose because they don't actually know what a high probability trade is, and if you don't know, you will keep losing. That's why I'm starting this high probability trading series with 3 clear goals: show you how to spot and take only high probability trades, help you achieve a higher win rate, teach you to act like a professional trader. This comes from 7 years of trading experience you won't find for free anywhere. Let's get started. Now, let's start with what is high probability, because that is the main purpose and objective of this series. What is high probability? A lot of people would say A plus setup. Other people would say we're seeing a B minus setup and it goes to C setup and other setups. Now, when people say high probability, a lot of people mean just based on what I'm seeing, based on the pattern itself, it looks high probability. But the reality and the real side of it is that if my trading plan or my trading setup requires 5 confluences as an example, if I see 5 out of 5, that is considered an A plus setup, because it's a setup that I need to take because it has all of the confluences met. However, when I have a B minus setup, based on the numbers and based on logic, it feels like we are only having 3 out of 5 confluences. So it could work, it could not work. It's not the highest probability setup because it did not meet all of the confluences, but it met 3 out of 5. So it could still work. So I'll take it as a B minus setup. So when we're thinking about high probability, it's all based on the confluences, the reasons that's telling us to take the trade or just leave it. So probability equal the percentage of the confluences on our trading plan. In other words, the more boxes checked on the trading plan on the confluences, the stronger the setup is going to be. So A plus, check more of the confluences, more of the boxes. B minus, we have some of the confluences not met. That's why it's B minus. Now, the goal of this series, we have multiple goals here, and I want you to go over one by one and see if you have some weakness in some of these points. The first one is building setups with enough confluences. So I'm not going to be just looking for specific pattern and then take a random trade based on, that's not going to work. This is not how professional and profitable traders actually act. So we want to focus on setups, build setups with enough confluences. So even if you don't have a trading plan after the end of the series, you probably could even make a trading plan out of the confluences and the episodes just one by one. So enough confluences or more confluences equal higher probability trades. So that is the focus. One thing we also need to understand before we go into the series is that, and I want you to understand it, to have a realistic view of probability or realistic mindset about probability. It's not about the next trade, because that's just a coin flip. That's a 50-50 chance. We don't know what's going to happen. But when we stack the confluences, when we only focus on high probability, this goes from 50-50 to maybe 70-30 or 60-40. It goes, it does not stay on the 50-50 probability. And this is what we need to understand, that probability shows up across a large sample, not one trade. So based on one trade, it's probably 50-50. But then the moment we have a larger sample, a larger number of trades, then this goes from 50-50 to another number, another probability. We cannot predict single outcomes, but we can predict results over many trades. Now, this is how an edge works. And if you look here, edge school, this is my community, this is my mindset, and my whole mindset and my whole theory on trading, it's all about probabilities. I'm trying to be on the side of the right probability in order to make money. So this is how an edge works. It's about the long game and not one lucky win. So it's not about your next lucky trade. It's about your next 50 trade, as an example, to make money from trading, or maybe next 10 trades to pass your funded account, as an example. Now, whatever strategy you use, because the confluences that I'm going to give you today and over the series, these are universal. That means they can be applied to any setup, any strategy you have as of now, or you can create your own. So these 10 components will make your current strategy even stronger, and they can be applied to, again, any strategy, any time frame, and any type of markets. Starting with Confluence 1, and that is price position. Now, price position, what is it? Every trade depends on where price is in the bigger picture. When we have a wrong position, and we're going to go to the definition, but I want to show you the significance and importance of price position. When we have a wrong position, even the best setup that you can, you're trading will fail because it's not in the right position. Now, when it's in the right position, even if it's a lower probability, even it's B minus setup, it could still work. Why? Because you are in the right position, because confluences stack naturally. If price has been going up like this and we're reaching, kind of a high of the range, and you're looking for this specific setup here in order to buy, you're looking for a breakout structure, that's not gonna most likely work. Why? Because initially you are not in a good price position. That is how you understand it. So even your best setup, it could be a liquidity sweep, it could be into an SNR, it could be an OTE into a Fibonacci level. It's not gonna work if it's not in the right position. So that is the importance. It could make your best setup like nothing, it's a losing setup because it's not in the right position. Now let's start with the basics. What is price position? It's the context. And when we think about context, what is it? It's where price is currently located within the market structure. So if we go and look at the recent structure or recent range, we can understand where are we relatively to that recent range. And in other words, it tells you if price is expensive, which means at highs, cheap at lows, or stuck in the middle. Now, when we think about the recent range, so let's say we have something like this. Now, price is here. Where are we relative to that market structure? We are at the highs, right? We are here. That means the price is expensive to buy here. And same thing, if we are here, price is cheap to buy. So we need to understand, are we at highs? Are we at lows? And we have some questions and we have a framework to follow, and you're going to understand this. But the thing to understand here is that if you were on a wrong price position compared to your position, compared to your trade that you want to take, the trade idea you have, and your setup, appearing at a wrong price position equal most likely failure, equal to a losing trade. So you always need to refer to the recent market structure, your recent price action leg or price action range. And then from there, you can actually understand the price position that you could have. Now, why it matters? Because a good price position is going to give you more room for profit, simply more profit and less risk to be taken. When I say less risk, means that you have less risk of price hitting your stop loss, okay? Less risk of being stopped out. Bad price position is gonna equal to small reward and a high chance of being stopped out. And also, to summarize this, you could have, when you have a good price position, you could have a much higher reward to risk and much higher win rate. The opposite is here. Bad price position is gonna equal to much lower reward to risk and much lower win rate. Now, based on 7 years of experience, I put these two questions to judge if you have a bad or good price position. Now, these are things you will not find anywhere. Why? Because these are things that I sit with myself and ask a question. When usually do I have a good price position and when I have a bad position? It usually comes from understanding and being honest with yourself when asking these two questions. Now, the first one is, am I chasing price? And you need to be honest with yourself. Now, if price, you think that it was going up aggressively and you think it's going to reach here and you want to buy. If you were, or if you answer the question with yes, I want to, or I'm chasing the price here in order to reach this level. And I know that price is going up and will continue going up. If the answer is yes, then most likely you are in a bad position. And what's that like in the chart? It's like price flipped up and you just want to buy reaching here. So you could buy here and then going up. But the risk of being stopped out is larger. It's much higher probability that it's going to hit your stop loss, especially if you play with a tight stop loss. Now we're going to go over the examples, but I want you to take these two questions, throughout the whole, until the end of the video, in order to know and, judge if you have a bad or a good price position. The second question is, where would my stop loss go? So if I'm entering somewhere, where would my stop loss go? If the stop loss that you went, you decided to go with, if it was too wide compared to the reward or the next obstacle, so compared to the reward, the reward to risk ratio. So if I have 10 pips stop loss, and then the reward or the next obstacle or the next higher low that I can target is only 5 pips, that is most likely a bad price position. So if you thought that the stop loss is way too wide, it's a bad position. And we're going to go over the examples, but I want you to be honest with yourself when taking a position and asking these two questions. If you were chasing the price, you need to be honest with yourself. Am I in a FOMO now just to enter buy because I think price is going to go up? I cannot wait for the retracement. These two questions, when you answer them, you'll get another answer, which is going to tell you if it's a good or bad price position. Now, looking at $Franc here, but before we go over the real examples on price position, let's think about some scenarios and if the price position is good or not. Now we're going to look for the relationship between higher time frame and lower time frame in this case. So as price is going up, we had price retracing, break-in structure, and now we're going down. Logically here, we are creating, so this is a low, we are about to create a higher low in order to go higher, right? So if here you were looking for, as price started going up here and price is reaching here, do you think it's going to be a good price position on the lower time frame in order to look for this specific pattern to sell? Not really. So if you were seeing this, this pattern here on the lower time frame, so this is lower time frame, this is higher time frame, do you think it's going to be a good price position to actually look for sells here using this pattern? Not really. It's going to most likely fail and price is going to go up because it is not, even if it's the best setup, it's not going to be in a good price position. So price is going to continue. A lot of times, if we have a key level here, and this key level, we always want to ask the question, are we in premium or discount? Are we, buying at a expensive level or cheap level? Are we selling in an expensive or cheap level? Now, in this case, if I take my range, now regardless of the bias, regardless of anything, because price could, just break above or could, respect this level. Now, we are thinking of the logic of premium and discount, and if we're having a good or bad price position, selling here would be much better than selling here. This is simply the context. So if price goes to this key level, and then we have this specific pattern, now there is a possibility that this could actually work and price start going lower. If I say this here, so if this pattern of the lower time frame was presented here, we could actually reach this level and then start going lower. And why? Because now we have a better price position. We're not selling here at a bad level. Now we are selling at a good level, at, in this case, a premium level. Now, same thing, if we take the range from this low to this high and looking at 50%, below that 50% is a good level to buy. So if price reach here, only here, we don't buy here because it's not in a good price position. Now, this is one way of thinking. It's about where are we in the, I would say, the current range and the recent market structure. Now, if we look at this $Franc on the daily time frame, I'll ask you a simple question. Would you be actually selling here, after this big candle here? Would you be selling here? Now, even though you made some profit maybe, but would you be selling here? Is it a good price position? Not really. And why? Because we had this big move here. Even selling here is not going to work. Now, yes, it worked this time, but if you notice, a lot of other times, it's not going to work, and you need a big stop loss, which is going to equal to much lower reward to risk. It's even better to look for buys when you have the confirmation, much better than sells. Now, look at this. We had this big move to the downside, and then we had a small retracement, and we had another big move. Do you sell from here? You cannot sell. Do you sell from here? You cannot sell, because we are not in a good price position. Even if you take your gap box here, from here to here, you'll notice that here we did not retrace to 50%, and then we started going lower. We did not reach 50%. We made another low here, and we have not reached 50%, which in this case is telling us that it's not a good price position to sell. So you cannot sell from here. It's not a good price position. We even prefer to look for buys. So you could look for buys here. You could look for buys here. Now, when price reach 50% of the range, then you might actually have a better price position. Now, it's better if price actually retrace here, but this one is a good price position to sell. You can sell, and after that, you see price are going lower. Anytime we go to the lows with a key level, you can actually be buying. Now, this is a very simple question here, or simple way to understand, and this is what we're going to be also discussing on the next episodes. But look at this here. What are we creating here? We're creating a high. So when we are creating a high, this could actually continue up. So I'm not going to be looking for buys, and why? It could continue up, but it could reverse at any moment. So any moment we could reverse to create the next higher low if we want to continue. So I'm not going to be buying here, because it could just go up like this and then immediately reverse, or it could reverse from here. So it's not a good price position to buy here, because the trend could end anytime. We don't know exactly. That is the concept of price position. All right. Now, when price is going lower, what are we creating here? This is a low. This is a higher low. So when price goes to a key level I'm looking at, then you ask yourself a question. Is it in a good price position to buy? Yes. Why? Because we have this low, this high. We are in the discount side. We are below the 50%, and we could buy from here. It is in a good price position. That is how you understand price position. Now, if we apply this anywhere, we have this range as an example, or we take it from here to here. We have this range. As prices come in lower, we don't sell, and maybe we buy here if we are in a key level. As price goes up into or about 50% in a good price position, this is a good price position, we sell from here. We don't buy here. Okay, you cannot buy here, you sell. Now price is going lower. After breaking the structure and after being way far away from the current structure, can you sell here? Can you sell here? Not really, because we never had. Now, if you're holding the trade, yes, you can hold the trade, but you cannot have another entry, because at any moment price could reverse. Now, you don't sell here. It's not a good price position. Why? Because let's imagine you sell here. Where could your stop loss be? And that is the main question. If the invalidation is way too far, if my stop loss is too wide, it's a bad price position. So if I enter here, where could be my invalidation? All the way here. What can I target? I don't see anything to the left. So even if you target something like this, even here, it's a much lower reward to risk. So whenever, now comparing to this here, if I enter here, where could be my stop loss? Here. And if you notice, maybe above this high. So I enter here, my stop loss here. It's not too wide. And what can I target? Maybe this next low. You see, that is an answer from me. That tells me that this is a good price position, and I will go from here. Now, I'm not going to sell from here. Why? Because I'm going to be having a wide stop loss. Now, taking the box from here to here, and this is 50%. Now, even if I enter here, where's my stop loss could be? Above the high. However, just above 50%. And we're going to be looking also at the scenarios of a perfect price position. Now, price reaching maybe a key level here. Okay, do I look for sells? Yes, because if I look for sells here, and if I have a confirmation on the lower time frame, even not on the lower time frame, if I enter here, where could be my stop loss? Maybe here. What could be my take profit? All the way down here. And that is telling me that this is a good price position. So just keeping it simple like this, always buy in a good level, sell in a good level. Always try to sell at highs and buy at lows instead of buying highs. You cannot be buying highs and you cannot be selling lows. You cannot be selling here. You buy here only when you have a a valid key level. So the core question remains the same. Where could be my stop loss if I enter this trade? If the stop loss is too wide, if it does not make sense, if it's even my account can't handle that, that means it's a bad price position. Even determining the price position can be just as simple as this. You zoom out and let's say we are here. All right, price is going lower. Can you sell from here? Not really. I can't sell from here. That's when you zoom out, right? So I'm zooming out. Now price started going lower. Can I be selling here? Not really. Selling here? Not really. Maybe buying here instead. Now, when I say buying here, that does not mean I'll just be randomly buying. No. When price reach a key level, when it gives me the confirmation, and then I want to pull the trigger, I ask the question, is it logical to buy from here? Are we in a good price position? Then if the answer is yes, I'll be entering. So entering here, going up. Now, when price going lower, going up, does it make sense that I can sell from here? Maybe yes. Now, price, for example, from this to this point or swing points start going up. Are we in a good price position to sell? Yes, because we are at a high. We are, making highs, we can sell. And that is the logic behind price position. All right, so it's something very simple, but a lot of people overlook it, and then what's the result? Taking a lot of unnecessary trades at the wrong price position, which is going to equal to a lot of losses, even if you take the best setup. Now finally, let's look at some bad price position examples. So if price is going up and then going lower, if we're looking at this high and we're looking for the breakout, a lot of times entering at the breakout, this is a bad price position. And why? Because a lot of people look to buy here when we have the breakout immediately and then having a stop loss below. A lot of times when we take a high, price is going to retrace lower and then going higher. So a lot of time you're going to be stopped out because you need a huge stop loss here to cover the low. And even sometime price will go to the low. And then your reward is going to be maybe lower because you're having, actually the reward to risk ratio is going to be lower, even your reward itself. Now this is example of a bad position, which is just entering immediately after the breakout. Another example is when we have a range and price is in a consolidation and then you enter randomly in the middle of the range, when in reality price could again go up to the extreme of the range. So when we have no clear or valid range, which is going to be discussing in the next episodes, we're going to be having a bad position a lot of times. So if you try to enter here in the middle of a ranging market, it's going to most likely go to the extreme level, and that's where you could have a much better price position. Now, why this is invalid? Because you don't have clear invalidation levels. This is not an invalidation level because even this here, you cannot put your stop loss above because it could still be taken. Now, this one here, same thing. You don't have a clear invalidation levels. And an example of invalidation level is when we have something like this, where price was going up and then a strong breakout structure of multiple levels, and then price is going above, and now we are in a good price position where we could sell, and this could be our invalidation level. Now what happened? You go up here, you sell, and then price going lower. So now you have a much better invalidation. Even this can be considered as an invalidation. So invalidation level should be a swing point or a level that has been respected by something that is in a good price position, that is, has done something. So it could break structure, it could take liquidity, fills a level, it needs to be a valid level. But in this here, in this ranging, this has done nothing. So it's not considered an invalidation point. Now, one more example is when we have, so as an example, prices going lower, and then after that, we have a huge candle like this. Now that is a bullish candle as an example. A bad price position will be entering here at the high. So for example, here, we're going to be looking for buys. we could have your stop loss here, all the way down here, maybe lower. That is a bad price position because after expansion moves, a lot of time we have retracement. So if you enter here and you put your stop loss here, a lot of time you're going to be stopped out. So you need to have a much wider stop loss. A good price position would be waiting for price to retrace maybe to part of the candle in order to go higher. Because if you ask a question here, based on this engulfing big candle or expansion candle, are you chasing here? Most likely yes, that means it's a bad price position. Now, good price position is when we have, for example, something like this, where we have a valid range to sell, and then price is going not only to the 50%, but to the extreme level. So extreme key level, the highest key level that you think price is going to go back to. For example, somewhere in here, this could be an imbalance, could be an SNR, could be, supply and demand, anything. So when price comes to this, this is the highest probability trade to take. Why? Because it's in the best price position that you can have. And why? Because if you sell here, your stop loss goes just above this high. So extreme levels in a price action range, they offer the best price position. Another good price position is OTE. So optimal trading entry. When I take my fib in a range, valid range, above 618 and then 279 and then also above here, this is a good price position. So if you apply this to any range, any valid range that you have from 618, this is where you're going to be looking for souls. Below that, it's not valid because price is going to go, maybe give a reaction, go give a reaction, go give a reaction. But then when it goes to the OTE, that's where you can actually trust it more. Because now, even if you just enter here and then stop loss above, it could give you more reward to risk than entering, at the below 50%. And when you take a precise entry with a confirmation, stop loss goes above the invalidation level, now you always have much reward to risk. So limit yourself to only take trades above 618, 705, 79, and you're going to have much higher reward to risk and much better win rate. So after all of this, what is the takeaway here? What is the one lesson that we need to apply to every possible trade that we take in the future? It is that if invalidation is too far, so if we have something like this, we enter short here, invalidation is here, then the position is weak. Price position is way too bad here. The best setups, on the other hand, are going to have much smaller stop losses and large clean targets. That is the main thing to understand from the lesson here. And now, since you understand this, the price position, the next episode will be to focus on the micro picture, the smaller picture. In other words, the details in the range. So that's it for today's video. If you like the video and if you learned something new, make sure to hit the like button, leave a comment also with your questions, because at the end of the series, there will be an episode where we answer the questions on all of the episodes. So make sure to leave questions if you have, and make sure to check out my community, Edge School, if you want to learn my trading strategy and if you want to be in a community full of professional traders. That's it, and I'll see you in the next video.